Ladies and gentlemen, welcome to the June 2012 webcast for Cadence Capital Limited. Turning to the fund performance for the year, we were up around 5.5% for the year, outperforming the All Ordinaries Index by about 12.5% and the Small Ordinaries Index by about 20%. We were able to achieve this whilst holding between 30 and 35% cash during the period. I think at its worst, the All Ordinaries Accumulation Index was down nearly 20%. So again, another year of great volatility for the overall market and a negative return for the year as well. The positions that performed well for us in 2012 were RHG Limited, Macmillan Shakespeare, Flexi Group, Bravura Solutions and Central Petroleum Limited. Positions that underperformed for us were Coffee International and First Folio Limited. I mean, actually the mining services in general performed very, very poorly for us in the fourth quarter and hurt our performance. We have recently been rated by EL&C Baillieu as the #1 Australian listed investment company over 3 and 5 years, and that information is available on our website in a company sector report dated the 18th of July 2012. The next 3 slides in the webcast cover the information contained within the EL&C Baillieu sector report, and I will just talk to each of them briefly. The first is the shareholder return for 3 years, and Cadence Capital Limited's return has been outlined in a circle and compared against the All Ordinaries Accumulation Index, as well as a number of the other listed investment companies within Australia. The second slide shows the shareholder return over 5 years outlined for Cadence Capital Limited and the All Ordinaries Accumulation Index. Of particular note there is the fact that the All Ordinaries Accumulation Index over the last 5 years has actually produced a negative return for investors. That is a very unusual experience for investing in equities in Australia over the long term, and there are not many periods in history when a 5-year investment time horizon produces a negative result for the period. The final slide is the comparison of dividend yield across a number of the listed investment companies, and we're pleased to say that Cadence Capital Limited is the highest ranking of the listed investment companies in terms of dividend yield, and of course in our case that is a fully franked dividend yield. It's also an opportune time at the moment to give you a portfolio update, as we are in the middle of reporting season. And I must say, for the first time in a while, I know we experienced this for the last year as well, the process of continuous disclosure is really giving us a very good insight into how our companies are going to perform and the earnings estimates that are to be expected from the companies even ahead of the reporting season, so that as of today, whilst many of our companies have not reported, we do have quite good estimates for the earnings profile for our portfolio, and a number of our companies have already reported. The first company to talk about is RHG Limited. They have recently confirmed that their full year profit guidance will be somewhere between 39 and 44 million, and that future fully franked dividends paid by RHG should continue to increase franking credits available to our shareholders. The result is a good one, and we are particularly pleased with that guidance. Reckon has already reported, and they reported a profit of 9.3 million for the half year ended June the 30th. They have a 31st of December year end, and this continues their excellent track record of profit growth. The rebranding project that they outlined earlier this year is underway, and all seems to be travelling according to plan there as well. Bravura Solutions, which in many ways has been a delayed performer for our portfolio. It's been in the portfolio for quite a while and hasn't performed that well up until more recently. Came out with an EBITDA upgrade in July with guidance of between $22 and $24 million for the year ended June the 30th. This was particularly pleasing for us because in the year before the EBITDA announcement was disappointing. Shares are up approximately 10% since that announcement, and I think are up again today. And the stock is trading on about a 5 times enterprise to EBITDA multiple, which for the sector is a low multiple. We believe the company to continue to be undervalued. The following slide talks to Flexi Group, which recently announced a full year profit of 61.3 million and is up 16% compared to last year in terms of profit guidance. And this number exceeded our expectations. The guidance for next year is for growth of earnings between 11 and 16%. The track record of strong profit growth continues. The surprise, I think, for the marketplace is that the CEO intends to step down at the end of 2012 after almost 10 years running Flexi Group. Flexi Group shares are up almost 50% since the start of the June quarter. And I must say, a finally getting what you could term a re-rating for a company that has consistent and strong earnings growth for the last 7 or 8 years. Finally, Coffee International, one of the disappointing returns in our portfolio this year. In April, Coffee downgraded their guidance for EBITDA for the year ended June 30th. This was primarily a non-cash write-down of goodwill in the project management division. This was disappointing as the company was expecting performance to turn around during this year and following its strategic review of 2011. And I must say that this non-cash write-down did catch us by surprise. I think the share price went from about 63 cents down to 33 cents at one stage. I'm pleased to say that since they have announced their forward-looking projections for next year, the share price has recovered quite significantly. The recent financials were released in August, and they have obviously the people are now looking past the non-cash write-off to next year's earnings, and we hope that that augurs well for the investment. The next 2 slides in the webcast presentation talk to the dividends for Cadence Capital Limited, which was part of the announcement of the Cadence Capital Limited full year result, and I would encourage shareholders to have a look at our full year result, the 4E release, as well as our media release and the newsletters that have recently been put out along with this webcast. We have had a number of inquiries in relation to our dividend and dividend policy going forward, so I've split this slide into 2. One is for dividends for 2012, and they are, we've already announced an 8-cent fully franked dividend for the final. That's a 4-cent final dividend and a 4-cent special dividend. A dividend reinvestment program has been implemented and will be operating at a 3% discount to the price. And on the current share price of $1.30, this full year dividend represents a 6.15% yield alone. That is, the final dividend by itself represents 6.15% return. The 12.5 cents of dividends that have been paid in 2012 represent a 9.6% fully franked yield on the current CDM share price of $1.30. This fully franked dividend yield represents amongst the highest fully franked dividend yields of all listed investment companies in Australia. Turning now to next year's dividend, and this is obviously an estimate. The company's stated dividend policy is to have a continuous and growing dividend stream over time. Assuming an interim and final dividend of 4 cents per share for 2013 and excluding potential special dividends, the dividend yield over the 13 months should be around 16 cents fully franked per share, or in yield terms, 12.8% based on the current Cadence Capital Limited option strike price of $1.25. I'd reiterate once more that given the high levels of franking credits contained within our company, management will be recommending to the Board of Directors to pay additional special dividends. Accumulated franking and profit reserves should provide relative certainty for future interim and final dividends, as well as the potential for special dividends. The following slide talks to franking and tax credits. Since our full year result, we have had a number of queries in relation to franking and tax credits, so we thought we'd just spend a little bit of time clarifying them as simplistically as we can. In terms of franking credits, CDM has accumulated significant franking credits, allowing the payment of approximately 21 cents of fully franked dividends before any future profits or dividends are earned. These franking credits create relative certainty around dividends over the next few years. I think importantly in this environment, where many companies are struggling to pay out a continuous and growing fully franked dividend, it is important to reiterate that we do have significant franking credits and are in a position to pay continuous and growing dividends over time. In terms of tax credits, something that we haven't spent much time on before, and trying to put this again in simplistic terms, CDM can earn approximately 18 cents of profit per share before any future tax is payable. This is a large tax asset balance and means that the next 18 to 20 cents of earnings are effectively tax-free. As management, we believe that this large tax asset balance is not currently being valued within the CDM share price, with our CDM share price tending to trade at pre-tax NTA and not post-tax NTA, which includes that large tax asset. Turning now to the Cadence Capital Limited options, option code CDMO on the Australian Stock Exchange. These options have a strike price of $1.25 and expire on the 15th of September 2012. Options exercised before and paid for before this date will receive the 8 cents fully franked dividend for the full year that's been announced as well. As of the 15th of August 2012, our estimated pre- and post-tax NTAs were $1.34.5 and $1.41.5 respectively, and the CDM share price closed on that same date at $1.31. As of that same date, our fully diluted pre- and post-tax NTAs, assuming that all of the options had been exercised, would have been $1.31.5 and $1.36 respectively. Many of you may have received a telephone call and will shortly receive letters in the post with an option notice allowing you to exercise your options. We're trying to tell people that these options do have value and that we would encourage the owners of these options and our shareholders to either exercise the options or alternatively to sell the options in the market should they not wish to exercise them. As of the 15th of August 2012, these options were trading at 4.2 cents, and I think today they were trading at around 5 cents. The last day that these options will trade on the ASX will be the 7th of September 2012. And any new or existing option holder who buys shares between now and the 7th of September will also receive an option notice holding in the post with the ability to exercise those options. These option exercise forms should be arriving at all option holders' postal addresses, and if they don't, please ring us or registries to make sure that they're made available to you. As Chairman of Cadence Capital Limited, I've indicated the full year result and again in our recent newsletters and now in this webcast that I will be exercising my options in the company. Turning now to the summary and outlook for Cadence Capital Limited. On this first slide, I've given a graphical representation of the performance of the fund, which is now nearly 7 years old. I think one of the really interesting things when looking at this slide, and I think it came up previously in those ELC and Baillieu slides, is the really poor performance of the All Ordinaries Accumulation Index over this period of time. The All Ordinaries Accumulation Index has returned 3.19% per annum for the last nearly 7 years, which for a period of time in history is a very poor performance for any equities market. And I think the point we wanted to make there was to reiterate that our long-term numbers and our long-term strategy remains in place, and we are committed to outperforming the All Ordinaries Accumulation Index over time, and we hope to maintain a record of 10 to 15% outperformance of the All Ordinaries Accumulation Index. The CDM investment approach and investment process remains unchanged since the company was formed 7 years ago and since listing nearly 6 years ago. We will continue to seek out stock-specific and industry-specific returns as opposed to trying to predict where the market in general is going or where the All Ordinaries Accumulation Index is going to end the year at the 30th of June 2013. The macroeconomic environment we are currently in is uncertain and ambiguous, and we don't see this situation changing in the near term or in the foreseeable future. The consequence of this is that index tracking or index replicating strategies will continue to experience volatility with continued uncertain return profiles. We indicated last year at our annual general meeting that we thought this would be the case going forward. It has been the case for the year just ended, and we think it will be the case again for next year. Our investment approach is not designed to try and guess where the All Ordinaries Index will end on the 30th of June 2013, and we think that these approaches will continue to struggle in this environment. However, current poor returns for the All Ordinaries Accumulation Index and the Australian equities in general will not continue indefinitely. At some stage, the market will return to equity-like return for equities, cash-like return for cash, And in that environment, equities returns should and will significantly outperform cash returns. Cash should never outperform equity investments in the medium to long term, or at least it has not been the experience in modern history. In summary then, the company has had a high-performing and highly ranked year, and in fact 5 or 6 years, and that has been reflected in the rankings amongst other listed investment companies. We also have amongst the highest fully franked yield amongst the listed investment companies in Australia. We have a relatively locked-in dividend stream for the year ahead and for the medium term. The CDM dividend reinvestment program will be operational this year, and a 3% discount to the share price will be in operation. The next 18 cents of profit earned in the fund are in effect tax-free. CDM is holding relatively high levels of cash, that is 32% of cash at the moment, and is ready to invest as and when opportunities present. And in this environment, opportunities should present. Interestingly enough, in more recent talks with fellow fund managers, fellow investors, and the investment community in general, the financial services community in general, there has been a feeling that the markets have not been very liquid, there has not been much activity, and there's not very much going on. Just at the point when you think that nothing's going to happen, of course, opportunities will present. And recent history has shown us that, and we believe will continue to show us that. There will always, at some stage, be opportunities to make good risk-adjusted return within the Australian equities environment. Ladies and gentlemen, thank you for your continued support as Cadence Capital Limited shareholders, and also with the options at the moment, potential new Cadence Capital Limited shareholders. And should you wish to get any further information in relation to our company, please visit our website at www.cadencecapital.com.au. And if you'd like, give us a telephone call in the office here. And we would encourage anyone who's interested to join our monthly newsletter, and that would allow them to receive our monthly newsletters as well as the quarterly webcasts that we produce. Thank you once again.